Good morning, and thanks for joining us here on Treasure Coast Solutions. Wednesday mornings between 9 and 10 o'clock. We don't have any answers to anything. We just think we do. So we're here talking about it, just like everybody else does. This is a real live national show because we talk about things that we don't know anything about, and we make stuff up.
Yeah.
And so my name is Mark Breckville. I'm a CPA, which gives me, of course, a right to talk about anything I want. I'm also
financially related, right?
No, just anything I want.
Just anything? Okay.
Just anything I want.
Let's talk about the Fermi paradox.
Well, yeah, because I have, in the past, I've stayed at a Holiday Inn Express. So I'm an expert on everything at this point, so it's kind of how it works.
Mm-hmm.
So, no, it's, I'm a CPA, ex-banker, not in jail, so that qualifies me to talk about most stuff. Not in jail yet, I guess that's the issue. But we're, for those of you that are new to the program, there are other channels you can tune into, but so I
have a numbers question for you.
Okay.
Because you're good with numbers, of course.
Go
no. Okay. So, and this always hurts my brain every time I think about it. 1/3 plus 1/3 plus 1/3 equals what?
3/3.
Or
1.
What's the decimal of 1/3?
0.3333333333333.
Okay. So do 0.33333 plus 0.333 plus 0.333. What do you get?
Depending on you round to 1.
But there's no rounding.
Well, see, that's because technically, this is an interesting thing. I'll just, as a little segue, I always have interesting little segues. But so technically what happens is that goes out to
indefinitely
to infinity.
Right.
And theoretically, that's what it does. So in the normal world, we round.
Mm-hmm.
So at some point we either round or we truncate, right?
Right.
So and it's funny because in audit reports and things, that actually causes you to be off by a buck. You know what I mean?
Mm-hmm.
When you actually put those numbers in and you do a calculation, if you don't round that calculation to a whole number, it results in you being off. And even if you do round it up, round it down, in that scenario, you're still going to be off by a buck because you're going to round to 9 instead of 1. So, you're still going to be off. But years ago, this is interesting. Years ago, when I was in public accounting with one of the big firms, or actually it was when I was in college in my audit class, they used to talk about different types of frauds and things that had happened. And, you always think of these very sophisticated things where people go in and, they create these really sophisticated type programs to steal, right? So when you think of computer fraud, you think of these really sophisticated things and somebody hacks into a computer and all that. But one of the biggest frauds that occurred is a guy worked for a bank. And what he did is, they calculate interest, right?
Mm-hmm.
So they calculate interest out to a certain point, typically cents, and then they
truncate
the remainder. So it just goes off into cyberspace. All right. So it just gets truncated.
Mm-hmm.
So what he did is he put a patch in the system so that instead of that truncated number going away, it went to the last account in the file. And then he went in and opened up an account under ZZZ supply or something like that. And so all of those truncations went into his account.
Isn't this the plot of a Superman movie?
No, I don't think so. But this actually happened. And you don't think about it, but on every account in a big bank, truncated every single day going into your account, the bank didn't notice it because it's just truncation. But and they would have known that their expense was the yield on their accounts was a little bit higher. But anyway, it went into that last account, and over a period of time, it was millions of dollars. And so what happened was, and here's how the guy got caught. You think, oh, they found him. The guy got caught because the bank was running a promotion, and the promotion was they were recognizing, for whatever reason, they were recognizing the first account and the last account. And when they tried to contact the owner of the last account, they found out he was somebody that worked for the bank, and they found him and arrested him.
It was a plot of one of the Superman movies. Richard Pryor goes in and writes code. I think instead of doing that, he said that the bank would round to the nearest penny, and so he would just take all those fractions and put it in his own account. And then in the movie Office Space, they did the same thing, and they log in the next morning. They think there's going to be like $10 in there, and there's a couple million. Well, and they're like, "Oh no, we're going to get found out."
And and the funny thing is, a lot of those movie things are based on true stories.
Mhm.
And so this actually happened. The other thing that happened, which a lot of people was a wire fraud situation. A lot of people don't realize that a commercial bank, a decent sized commercial bank, $1 billion or $500 million or whatever, they're going to run hundreds of millions of dollars a day through their wire transfer area. Where they're taking money and wiring it out to buy, to buy Fed funds or whatever, or for customers or whatever. All of that's going through their wire room. So they'll have a wire room that maybe only a few people, and it's actually touching millions and millions of dollars. In the big banks, it would be billions and billions of dollars a day. So out in California, so now you think about, well, how do you steal? How do you hack? There's no money in robbing banks. The interesting thing is, from an auditor standpoint, a bank's cash in their vault is immaterial. So no bank is keeping a significant amount of cash on hand. It may be significant to you, but to the bank, it's not significant. The big money is in securities, their investment securities that the bank owns. That's their large investment, and of course, then their depositors' money. So the question was, how do you get to money in the wire room? And so what happens in the olden days, and it's still kind of the same thing. It's a password thing, but what happens is, in the wire room, every day they have a wire code that is that day's current code for their branch people to be able to call in and order a wire transfer, right? So that they know that that's actually a legitimate wire transfer code, and that they, and they changed them every day. So this involved a non-bank employee, because if it came from an employee, that you'd be able to track it down. So what happened was, a telephone repair guy was called in to go into the wire room and fix the phone systems, because in those days, most all of this stuff happened via phones. So went in to fix the phone system, and the code was written up on the wall for that day's code in the wire room in a big bank in California. And so he took down that code number, and then he went out and he went and set up an account, and he wired $10 million. He called in and wired $10 million out to his bank account outside of the bank. He wired it out of the bank to another bank's bank account, to a $10 million into this account. And then he immediately converted it to diamonds. All right. And they finally caught him leaving the country. And he still had the diamonds with him. But so you think, okay, they got restitution. Well, the problem was, he bought industrial grade diamonds, so they weren't worth $10 million. They were worth like $1 million or something, or less. And so he ended up. So they ended up catching the guy, but they got nothing back on the deal, really. And it was funny, because it was all strictly from people outside the bank that committed. At that time, that was one of the biggest frauds that had occurred in the banking industry. It was one of the biggest thefts ever of a bank, was through, and it was a fairly simple process of just writing down a code, taking it out someplace, and calling. So it's kind of interesting.
That's funny.
So it's kind of interesting how some of those things happen. It was kind of a neat, interesting situation. But anyway, I want to talk about neat and interesting things. So that's a good thing. And if you've got something you want to talk about, 220-9788, 220-WSTU, we'll be happy to get you on the air. We just ask that you keep it civil. Today is a big day. The American pastime, which is lying, cheating, and spying on other people, is coming to light. We're going to get to the bottom of it, and that just involves baseball. So it's kind of interesting, but it is the American pastime, so it should be it's appropriate and somewhat ironic that Washington actually won.
Yeah.
So
Washington beat the cheaters?
well, the question is, are they just better cheaters, or did they figure out they were cheating? And see, here's the thing: if you were smart enough to figure out that they have a reputation for cheating, then what you would do is certainly change everything, and then figure a way to do something differently so that you would set them up, right? And now you start wondering, did the Nationals actually figure something out and then cheat back using it? I think that's probably what happened. So now, and especially since it's Washington, D.C., you can't trust those guys to start with. They have all kinds of technology that they could be. I'll bet you the FBI is involved in this. Maybe the CIA. I'm thinking.
Some senator.
I mean, that was the only thing all those politicians could agree on in the last month, right?
What
They all
was
wanted
that?
the Nationals to win.
Well,
So,
that's true.
see, that's all it was. So I'm pretty sure that they're going to bring the resources of the U.S. government to bear on getting the Nationals to win. I think they cheated the cheater. That's what I'm thinking. So I think,
So are they the good guys?
well, I don't know. I've lost track. So I think we should have an investigation. It's time. Get rid of this impeachment stuff. That's just old news. The Congress should spend some valid time right now getting to the bottom of this Washington Nationals versus Houston Astros possible, I think. I mean, I had somebody tell me who told me, and they were told by somebody else who told them from a reliable source within the organization that maybe they were stealing signals from the Astros.
Oh, but wait, after hearing all the other reports, one of the key players on that Astros team revised his testimony and said he was actually the one stealing signals.
Right. That's right. So I think we need to get to the bottom of this. I think the Ukraine is involved. I'm pretty sure they're involved in every single thing that happens in the U.S., and I think that they should be investigated. But anyway,
and I'm just the average baseball fan.
That's right. That's right.
That was horrible. I apologize.
Anyway, but I think we need to look into this because definitely it's there's something going on that's fishy here, and we need to find out. It's funny because the thing lacks credibility to some degree because baseball is so darn boring that you would be asleep. There's nobody that would even. They said that the person was in a massage room. On a massage, you'd be asleep. You wouldn't be. I mean, that's a boring game.
They were in the tunnel.
Yeah, no, in the tunnel. That's a long. A long time. I just can't imagine. But it's funny. Having played baseball, there was having played baseball. There was always the concept of trying to steal signs. I mean, we did that. Everybody did. Everybody did that. We had.
I actually thought it was illegal.
No,
because I always thought I had heard of people getting in trouble for trying to steal when they were on second base or something.
No, you
can.
Yeah, you can. That's why. First of all, the catcher never uses the same signals. Most catchers have alternate signals when there are runners on base. So they don't use the same set of signals. So if one's a fastball, it's a slider when there's men on base.
Mm-hmm.
So, actually the pitcher and catcher, you ask, well, how can the catcher puts down a 1. How can the pitcher throw a slider instead of a fastball? Well, if 1 is the signal for a slider when somebody's on base and the pitcher forgets, next thing you know, the catcher's getting a pitch that they had no idea they were getting. Right. So yeah, and that's why, because you can do that, that's why catchers don't set up where they want the pitch delivered initially, because the batter can see it, and certainly somebody on base can see it and can say, where it's going, where the pitch is going, and they can steal the signals. And so there's a whole lot of alternatives, and a lot of times with signals, it's not just a 1, 2. I mean, that's a pretty difficult thing to steal a signal. It does take a lot of nowadays with technology to be able to log all that in and cross-reference it. You could probably do that, but you would need a lot of information because, for example, if like I say, signals, a lot of times if you don't touch your thigh or touch your chest protector first before you give the signals don't count. Or it determines how many times you touch something determines which pitch it is, what the signal is. So they do a lot of that. And the coach even is giving many times the coach is signaling the pitch in
Mhm.
from the from the side. So sometimes what the catcher's giving, unless the catcher is brushing something, unless the pitcher's brushing off a pitch and asking for another one, it doesn't really count.
Now, on the other side, on the offense, the coach is the one over at third base, usually, at least in the minor league or at least in little league.
Right.
I don't know if they do it in the pros, but the coach is over at third base sending in signals.
Absolutely.
And they've got the whole, if I pull on my earlobe, it means do this, and everything else after that's irrelevant, or the fifth sign I do is the only thing that matters. And they've got all these crazy things. But I've noticed at the high school level, and I don't watch professional that much, so maybe you've seen it there. At the high school level, some teams are going to the quarterback wristband. So the coach doesn't go through the whole, show and pony dance of pulling on the ear and wiping his jersey and slapping his knees and all that stuff. He just actually will yell in a number. The batter looks at their wrist, see what it corresponds to, and then does the play.
Yeah, the trouble with that is that people are listening to what that number is, and so if it's the same number all the time,
right.
Now you know what's coming in.
But you've got ways of changing that.
Typically, what they do is there's a couple different ways to do signs. One is what you had mentioned is an indicator. So you like crossing my chest. If I cross my chest, that's the indicator. So now you count. Now you count or touch. So. There's things like if I touch my belt, it's a bunt. If I wipe across my chest, it's steal. Whatever, a hit and run. A bunt and across my chest is a bunt and run. So you could combine them, you could mix them. So and typically they'll use an indicator first, so that whatever I touch before that doesn't make any difference. But once you've touched the indicator, then the signs are live, and then they mean what they mean. All right. Many times they will also alternatively, what they use is a counting system. So it might be how many times you touch skin. So whether it's on your face or on your arm, if you're touching skin, it counts. And then you keep track, and the batter knows, okay, 3 is such and such, and then if there's a second sign, or 4 is bunt and run, so then you have signs and you count. And there are different things, and they switch those out all the time. I mean, there's and who's giving the signs can vary. Sometimes it can be the third base coach. Sometimes it's sometimes it's the first base coach. Like it used to be, sometimes the signs didn't count unless you were in the coach's box. So the coach would step out, if the coach was in front of the coach's box or behind the coach's box, and usually they weren't behind because it was hard to see if they were actually in. But usually if they stepped forward and were outside of the coach's box, then the signs weren't live. So they would, and they would purposely give signs that they had given before that the person bunted or whatever, so that the other team would pick it up and say, "Oh, that's a bunt," So it's the same thing with pitches on pitch counts. The thing is, most of them are pretty straightforward if there's nobody on base. So that's why the camera makes a big difference, because if they don't realize that there's a camera out there, they're probably not hiding their signs. They're not going to the second sign.
Right. And there is a rule in baseball that says you cannot use technology to your advantage in that method. That would be the rule.
That's obvious. We're still using wood bats.
Yeah. So you can't gain an unfair advantage by using technology, which if they were using a camera to steal signs, that's a pretty clear violation of that particular rule.
Probably.
And it's all former players that used to play on the team that are now going, "Oh yeah, we used to do that all the time there."
Right. And then what they're not telling you is that their current team is doing the same thing.
Well, sure.
It's like in football. I mean, the playbooks that are there in football. I mean, think about it. You've got guys like Belichick that have been coaching forever, right? And you don't think that they're changing their playbooks every year. They're not going through and changing all of their plays and coming up with new plays every year. And it's the same stuff. And he's going to use the same stuff in basically the same situations most of the time. So you take a player that's been on that team, for any length of time, they're going to have a pretty good indication of what's coming. When it comes to that kind of thing. That's why there's such a difference between the quality of the pro players and the quality of the college players. College players, they do a lot of study, and they figure a lot of things out, but basically they're able to it's tough for them to perform when the other team maybe doesn't know exactly what they're going to do or does know exactly what they're going to do. And so to some degree, the knowledge of what the tendencies of the team you're going to play in college make a big difference. Some guy like Saban that's been around a long time and knows how these other coaches coach, and sharing that knowledge with his defense makes a big difference. Right. But in the pros, to some degree, that's kind of taken out of the picture because they all know each other so well. They've played so many times. Like, you know how hard it is in college to play a team that you haven't played before, right? You've got film, but you don't know what they're. So for example, in the SEC, when the SEC plays somebody out of conference that they don't normally play, there's a lot more prep time that's involved. When Alabama's going to play LSU, they may have 1 week more of prep time this year. But it's not significantly different, because they've played LSU and they've coached against these guys time and time again. They know their tendencies in certain situations. They know what they will or won't do. I mean, we'll know that Mullins will go on fourth down, so you got to be prepared for that, right? And then what kind of fourth down plays he's got, because you got all of the stuff that he's done at Florida, and you got all of the stuff that he did at Mississippi State, and all of the stuff that he did at Florida the first time he was there. So, you've got a lot of film and a lot of things on his tendencies. But at the pro level, they do that, but they play each other so much that they kind of all automatically have that kind of, it's unusual for a pro team to play another team that they haven't played in 5 years,
I think part of it too is you've got professionals, the good ones anyway, are going to be studying film and doing a lot of work throughout the day, stay up late, getting early, do all that stuff besides all the physical work. Whereas in college, not only are they having to study film and do all the homework and do all the physical stuff, they've got to go to their other classes supposedly.
Yeah,
and they're college kids, so they got to party.
That's right. That does happen.
So they don't get to spend as much time on the prep work. So when you're going against the team for the first time and you don't really know anything about them, it's not like they're not going to be learning about it in their study sessions like a pro would.
Right. Yeah, that's what I mean. They've played against each other so many times. I mean, I'm amazed that Belichick and Brady still continue to win with the amount of information that's available out there on them. I mean, when you really look at it, and it just shows how good those guys really are.
I also think they're at the point where they're the boogeymen. Yeah, and they psych out opposing teams. I know as a Steelers fan, they beat the Steelers most years before they ever take the field. The Steelers psych themselves out of those games,
right? In
a lot of those instances.
Yeah, and I think there's at the pro level there's a problem of trying to do too much sometimes too. One person wants to kind of, especially the quarterback wants to kind of take over the game, and at the pro level you need to be able to play within yourself. I mean, you're a pro, so you're a good player. So if you play the way you're supposed to play and everybody else plays the way they're supposed to play, you'll win games. Everybody doesn't have to play greater than themselves. I mean, it really is. That's what it boils down to on a day-to-day basis. But when they're playing a good team, I think there's a tendency to want to try to play at a higher level and raise your game. And unfortunately, that doesn't always work out for people. But anyway, it's interesting. So that's what I was wanting to talk about today was the American conspiracy in baseball, and so it's a good subject, a good topic for
everything's bigger in Texas.
Everything's bigger
even the scandals.
That's right. That's the way that works, and I feel bad for my Houston fans because there's a number of them around here. It affects our community.
That's true.
So
didn't think of that.
Yes, it does. We have that local connection, and the benefit that it'll bring. I think that now that the Astros maybe have got some issues, and this has been a problem, that we as fans and locally here, we need to do our part. So when spring training rolls around, I want you all to take your iPhones out to the ball field, and those of you that are sitting out in center field, and then maybe even right and left center, I want you to stream live the catcher during the game, so that we can, because the Astros aren't going to be able to do that because they're not allowed to use technology, but you can use technology to help your fans. It's like in college football, where as a booster, you pay for your star athlete's car because, right, the school can't do that. But as a booster, I guess I can, right? I just hire them to work at my dealership, and the next thing you know, they're driving Maseratis. I think it's happened before. One of those schools, I think Auburn or someplace. But anyway, and I can always take a bash at Auburn. But anyway, so do that. That's what our goal should be for spring training this year. And by the way, those of you that actually have good seats down the lines, you can use your camera to photograph the other dugout. And so that we can maybe see what's actually happening in the dugout, and then we can tie the two together. And it should be really cool. It's a nice, fun project for baseball fans when you're sitting there in a pitcher's duel. I think it does give more interest to the game. The pitcher's duels are really boring unless, we're all trying to steal signals. And that would be really cool.
Yeah.
Just think, if you're the person who, through stealing signals, you help spoil that no-hitter. Now, that would be fantastic, wouldn't it? Because that pitcher, he gets paid a lot of money, and he shouldn't get that. So if you can help your club, make sure all it takes is one hit.
Yeah.
So if you could get the one pitch right that breaks up that no-hitter, think about that. It doesn't make any difference if that's going to set a record for the most consecutive no-hitters in a career.
Yeah.
I don't care. It should be done.
That's way better than throwing back a home run ball.
Yeah. Cubs are way behind. That they got to start. And you know what? Speaking of the Cubs, they didn't win anyway. But speaking of the Cubs, they got tons of places to spy. I mean, they got buildings all over that place. Think about it a minute. You're going to have to bring in the CIA just to block technology out there. The Cubs, they've got tons of ways to do stuff. And it's kind of interesting because there's people all over the place looking in at Wrigley Field. So I think it's a pretty good idea. I think it sounds like fun. Speaking of sounding like fun, let's talk a little economics and a little finance. They're interesting fact, Mike. I saw this and I was going to look it up, and it was published in something reliable, which I kind of might be throwing the Stewart News in that, but so that might not fully qualify. But no, it qualifies. No, I forget where this was, but interestingly enough, that the average, if for an individual to be in the top 1% of income earners worldwide, not in the United States, worldwide, you have to make an income of $34,000 a year or more. So it really goes to show you the disparity between countries and the U.S. And it also goes to show you that that if you were going to redistribute wealth at the global level, the amount of redistribution that would have to take place, particularly from the U.S., it would take a significant amount of money from the U.S. to get some sort of global equality. This
is from an article I'm looking at in Investopedia. It was just the first one that popped up from September of this year. It said that according to the Global Rich List, a $32,400 annual income is enough to place you in the top 1% worldwide. In the United States, you must pull in $421,926 to be in the top 1% of wage earners strictly in the USA.
Right. Now, think about that a minute, though. $421,000 is not a lot of money. It's a good salary. It's good income.
I would argue that.
But there are a lot of people, particularly, there are a lot of people that are making that kind of money and really what they're talking about is, you're talking about income-wise. If you're filing a joint return, I'm sure they're not cutting that in half. So that's your taxable income. That's your total taxable income on your tax return. So for an individual, $400,000 would be a lot of money. For a couple, $421,000 would not be a lot of money.
I would argue that.
Well, if you get two people working in corporate America and they're working in upper level middle management jobs or lower executive level jobs, $250,000 a year, $250,000 a year is not a lot of money. If you're in a large real estate company and you're the sales manager of a large real estate company, $300,000 or $400,000 a year is not a lot of money. When you look at commission people, that's not a lot of money. I mean, it's going to include a lot of people that a lot of people don't think are rich. Most people think $400,000. I mean, most people think the top 1% wage earners are people who, are sitting clipping coupons and, are billionaires. That's not a billionaire. 400,000 is not a billionaire. In fact, it's probably not even a millionaire. Depending on the situation, it's not even a millionaire. The other thing that's not in those numbers, which is something that's interesting, is that 1% isn't the same people all the time. And that's what confuses people, that it's not the same people all the time, and it's not cash. Many people think that when I make $400,000 a year, that I get $400,000 in cash. Because with a job, you do, right? They pay you once a month or every other week or whatever you get paid, and they actually pay you in cash after taxes, but they pay you in cash. So that is a small portion of that. The number that you've got is somebody who gets a K-1 from a closely held S Corp or partnership, and it reports $400,000 worth of income to them. Now, they may not have gotten that income. That income may have gone to pay debt service on the money that it took to buy the business. It may, and that's not deductible. So when you pay the principal on a loan, you don't deduct that payment of the principal. You can deduct the interest, but you're not deducting the principal, which is the bigger payment in a business. And so you have to make a profit to be able to generate enough cash to be able to pay that principal. Now, you can argue that that's going to build the value of your business. You're paying down the debt, so you have more equity in your business. So from a value standpoint, it's creating wealth, but it's not creating income, and it's not creating cash. So it's creating income, but not cash. So here's the thing that people have to realize when you hear people talk about, let's increase the tax rate on small business, because the top 1% is mostly small business. In fact, the ironic thing is, many times it is a small business owner who's owned their business for 40 years that sells it one time. It's their retirement money. They decide to get out. Think about the people in this community who had businesses for a long, long time, and then they retired and they sold it for $1 million or $2 million or $10 million. And now that's a lifetime worth of earnings. That's money that they've basically worked for maybe 40 years or 50 years. And they're one-time cashing in. Yet from a statistic standpoint, it's considered that they're making that kind of money every single year. And that's not a billionaire. They didn't sell $1 billion business. That's a whole different story. And there are a few of those, but most of those have more flexibility. A lot of the billionaires, they have publicly traded companies now because they've gone public, and they've already sold out and cashed out some of their money, and they have the ability to move it if you tax them. So billionaires that actually have the cash also have the ability to do things that they don't have to pay tax on the cash. But what we're talking about is a relatively consistent group, but not the same people. When I'm talking consistent, it's as a percentage, it tends to be the same amounts every year, but it's just that constant income that's from the one-time sale of a business. And as our population is aging and reaching retirement age, we're starting to see more and more of that. Now, fortunately for us and for them, many of those people, because of the recession, were forced to stay in their business longer. But I think you're going to see more and more of that. And it looks like you've got more income coming in, but you really don't. Like a lot of those people, it's a one-time deal, and that's the money that they're going to retire off of, or maybe that they're leaving to their family for their family to, because their family may have participated in all of that. So it may be money that they're leaving. They've decided to sell the family business. And that's why I always say to you on the show, we always talk about, I say, when you hear a politician start talking about taxing the wealthy, make sure you know what their definition of wealthy is. And by that, what I mean is not only the dollar level, but the quality of the income. And I'll give you, just like I say, two things. If on paper I make $400,000 this year, but I'm having to use 300,000 of that, or 200,000 of that, let's say, to pay down principal on a loan that I borrowed the money to acquire that business, right? That money's not going in my pocket, and I can't. Technically it's a choice. I'm paying the debt, and yes, as I'm paying down equity, I'm creating wealth or value in the business, but I don't have the cash. So now, if you tax me on the 400,000, which is, by the way, what you're taxed on, you're not taxed on. Small business is not taxed on the cash they take out. They're not taxed on distributions. They're taxed on income. Distributions are always less than income. They're always less than income because of debt payments and equipment that has to be purchased and inventory that has to be purchased. Otherwise, the business goes broke. So it is always going to be a situation where there is less cash than income. So let's say I'm in a 50% tax bracket, and that's a 40% federal income tax rate, and let's say it's a 13% state tax rate, like Oregon or California or one of those places. So I'm at a 53% total rate. Now I got $400,000 worth of income, and I'm paying 53%. So 47% of that is what I'm getting to keep. Well, that's not enough to cover my debt service. So basically what I'm doing is I'm making no income. I'm having to pay all of my cash to debt for the business. So, you can't eat wealth. You can't go to the store and say, look, I got this company that's worth X amount of money. Could you give me a cheeseburger with fries, and I'll give you 1/1000% of my income next month, or whatever. You can't do that. They won't do it. So at some point, when the tax rate reaches a point that the entrepreneur who creates all the jobs in this country, by the way, you can forget Wall Street, they're not creating anything. But Main Street is. So if you get to the point that you're taking away enough of the entrepreneur's income that they can't survive, or that it's not worth it anymore for them to make that sacrifice. And as people get older, that becomes less and less worth it for them to make that sacrifice. When you're 25 or 30, you might be willing to work 70 or 80 hours a week for less than minimum wage. When you get to be 65, you're not as eager to work 60 or 70 or 80 hours a week for less than minimum wage. You want some of the toys that come with the fact that you've spent all of your life plowing money back into your business. And so that's why people cash out. And in the short run, that's a great thing for the individual. And if we tax the heck out of them, it's, we get some money, but it's a one-time payment. It eliminates a lot of jobs, because a lot of times the business that comes in is already in that line of business, and they consolidate it, and they eliminate a lot of management positions and a lot of higher paying jobs. So what we do is ultimately encourage unemployment in a roundabout way. Is if I sell my business because I don't want to work for nothing, because I've taxed it away on an annual basis, then at that point, I'm going to take that cash. I have to live on that. The buyer is most likely not going to do the same thing, because they can't justify the price that they're paying me unless they can reduce their costs or increase their sales. Well, they're going to increase their sales because they're going to pick up some of my business. But if they can increase their sales and then reduce their cost, then they are going to, then they'll be able to potentially make some money on the deal. So it's interesting because, like I say, depending on what you're talking about, like, for example, a 60 or 70% income tax is devastating to the economy. It would because it would force many small business places to many small businesses to go out of business because they don't have the cash to pay, and the government will not take an IOU. You could get by with that once, maybe. They charge a ridiculous interest rate and penalties. So you'd be better off going to your local loan shark, borrowing from them. But ultimately, if the government confiscates more cash, and that's the key. If the government now changes the tax laws to such that you only get taxed on cash, that's a different story. Now it would make sense for me to be able to push some of this value out there and wait down the road, because I'm not being taxed on it. I'm paying for it, but I'm not being taxed on it. I'm not getting a deduction for it, but I'm not having to pay the taxes for it at this point. But again, that's and you say, well, I file a cash basis tax return. I understand. You file a cash basis tax return. But what I'm telling you is the income is cash, even if it's cash coming in, right? The debt that you're paying off, the equipment loans, the car loans, the truck loans, the equipment that you buy to sell, inventory, the debt that you pay for the building that you're in or the property you're in, those are not deductible. You may have gotten a deduction for the item, or you may be getting a deduction for the item over time, but the payments that you're making are not deductible themselves. And so it's possible that you don't have a deduction to offset those payments. In fact, in many cases, it's most likely the case. Now, the reason is you may have taken those deductions up front, which saved you some cash flow. That was the only reason you were able to pay your taxes the previous year or the year before that. But at some point, you're paying the piper, and there's no cash to do that, to pay the taxes. So that even in the small business world, taxing at those rates on income that's not cash in your pocket will result in a loss of jobs, or either through the sale of the business or by scaling back because you can't afford it anymore. Most business owners, if they run into a tough time, they have to get cash. The main way that they can get cash is to fire people and take over their job, because you can't afford to pay them anymore. You don't have the cash to pay them. You got to pay the government. Now, technically, you're paying yourself, but you're paying yourself in the cash you would have paid them, because they get paid in cash, and you're using that cash to pay the government. So it's really a question of not making more money, because if you make more money, you got to get the cash to go with it. So you've got to eliminate a cash payment. I've got to eliminate debt, which I can't do because I got to use cash to do that. I've got to eliminate inventory. That's going to cut my sales. I can't do that. I can eliminate accounts receivable. Well, that's money I already sold, so I don't want to eliminate that. That hopefully is going to turn into cash. So what's left that I pay out that I can eliminate? Employee salaries. It's as simple as that. I just let somebody go. Think about it from this standpoint. Let's say you're in the local, you're a local landscaper, right? And you've gotten to the point now where you've got a couple crews, and you don't have to go out and cut grass. You've got 2 or 3 crews out there, and you're starting to make some money now. Now you're starting to make a little bit of decent money. You've got loans out there for your equipment. You had to buy that equipment. You probably didn't pay cash for it, especially if you had to add crews. So you had to go out and buy equipment for those crews. So you've got some debt out there. You need to pay that debt back. And you're probably, if you're lucky, you're paying that debt off over 5 or 7 or maybe at the most 10 years. So the equipment you got a deduction for when you bought it, but there's no deduction for it now. So now on paper, you're making money. You've got a couple crews, but you're not getting enough cash to pay your taxes, because it's all going back in the business to support those crews and to support those to support the payments you got to make. So what are you going to do? Well, the first thing you're probably going to do is if you want to continue to grow the business, the first thing you're going to do is I'm going to eliminate some of my accounts. I'm going to definitely eliminate any of my accounts that aren't profitable. but I'm going to try to eliminate some of my accounts. Well, that's kind of self-defeating, because if everybody starts thinking you're not looking for new business, all of a sudden you're going to stop growing, and you need to grow to be able to make the money to pay for all of the stuff you bought, because it assumes you're going to continue in business. So getting rid of customers, unless they're unprofitable, doesn't make sense. So the next step I'm going to do is, whoever was my crew boss on whatever crew is really got the easiest work, I'm going to take that job over. I'm probably going to let my assistant crew boss or one of the people kind of run things, and I will periodically show up and supervise. So I'm probably not going to do as good a job as I was doing if I had somebody who is with the crew all the time and knows what kind of mistakes they make and knows what they're not doing and can keep an eye on them and can keep them working. But that money that I was paying, the $35,000 or $40,000 that I was paying to that crew person to run that crew, I get to keep. So that goes in my pocket. Now, I'm not going to get to keep it. I'm probably going to use it to pay taxes. But I may also, it's going to give me some cash so that I get to take home something and I can pay my bills. Because if I can't get enough cash out of the business, I can't pay my mortgage. I can't pay, any of my expenses for any of the my car, my personal expenses. And trust me, people, small business owners don't get to deduct all that stuff. In the old days, the ability to throw all that stuff in your business and deduct it was possible. Today, it's not. There's limitations on it. Entertainment expenses are limited. Vehicle expenses, they look at very closely for an owner. All of those things are pretty difficult to get away with. The old days when every person's mortgage and real estate taxes were being paid through the business, their personal loans were being paid through the business. That didn't happen. Those that are doing it are really just going to be looking forward to an audit. And when that audit occurs, they won't be able to argue that they didn't know. And so at that point, now what you're doing is you're dealing with the IRS from a fraud standpoint, not from a incorrect tax return standpoint. And that's a whole different environment. When they realize that you've been cheating them on purpose, and you knew that because you were running all of these personal expenses, it is not pleasant. That involves criminal stuff, whereas the other is just civil. So it's just a penalty. But when you move into the criminal tax evasion, tax avoidance is allowed. If you make a mistake in tax avoidance and it's just a mistake, okay. But you're probably not going to jail. But if you've done tax evasion, you're going to serve some time. So keep that in mind. You don't want to go there. All right. You don't want to go there. So that's just something that you need to be thinking about. So anyway, so I like I said, I want you to. I mean, I know that from a government standpoint right now, we're not focused on anything financial or economic. We're just sitting there dwelling in nothingness. Nobody's dealing with any of this stuff, really. I think the president is trying to deal with some of the stuff, especially with the Fed, but nobody's dealing with any of these things in general. But these are things that we need to look at, because if any of these things change, it's going to shut the economy down pretty quickly. And even some of the rules and regulations relative to making money and not making money are slowing the economy down. I've talked about that previously. The whole appraisal statutes are causing problems. But so keep an eye on this stuff. And when you look at some of this stuff, think about the fact of what a wealth tax would do, because a wealth is not cash at all. That's if you own a piece of property that's worth $10 million and you paid $100,000 for it, you own it free and clear, you're going to pay tax on that. That's a wealth tax. Where are you going to get the money to do that? You're going to have to borrow against that property to pay the taxes. Think about that. Anyway, that's it for today. And we will make sure you stay tuned to America's Pastime. And that's going to be exciting. And join us every Wednesday right here on WSTU Digital 1450, because you know what? We're Martin County's very old and sometimes relatively informed station. So join us Wednesdays, 9 o'clock.